Okay, boys, let's look at this 2019 company final accounts question. Okay, a lot of these workings as you'll all be familiar with. There is a quite a maybe 4 or 5 that will be new to you. Okay, so I'm going to do the full workings here for you. All right, and then post them up for you guys, and then I'll give you additional instructions on teams. So the first working we're going to look at here, lads, is your closing stock. Okay, your closing stock figure is given to you here in the trial balance of 75,400. You're then told that there was damaged stock which cost you 6,000, but now is only worth 75% of cost. That means you made a 25% loss. Therefore, 6,000 multiplied by 25% gives you 1,500. Okay, and that is the first working complete. It says then during the year, stock which had cost 7,000 was destroyed by fire, and the insurance company agreed to pay compensation of this 5,100. Okay, in this case here, you want to open up purchases. The purchase figures that you get from your trial balance is 1,045,000. And you're going to take away stock which was worth, okay, 7,000 from this. If you look at the English carefully, it says the insurance company have agreed to pay 5,100. That means that this is a current asset because it's due to you, okay? You have not received it yet. More importantly, you've made a loss on the fire. You've lost stock worth 7,000 and you've only received 5,100. Therefore, the difference between the two, which is 1,900, is considered an admin expense. Okay? The next working is a new working, okay, that you would not have seen before, and it's just to do with the depreciation of delivery vans. It's actually easier than the other way, okay, it's just that it had never been seen before, and it really threw students in the exam. If you look at this carefully, you can see that the cost of delivery vans is to be written off on a straight line basis over 5 years, which is similar to something you've seen before with patents. You're just simply dividing the cost of these delivery vans by 5. And a full year's depreciation is to be charged in the year of acquisition. The term acquisition basically means in the year in which you acquired it, the year in which you purchased it. And then there was obviously no depreciation to be charged on the year of disposal. Important to note that delivery vans have a 5% scrap value of the original cost. What does this simply mean is that the delivery van will never be worth zero. Okay, delivery vans, the lowest it will ever get to is 5% of its cost because that's what you will get when you bring it to a scrapyard. It also says then during the year, a delivery van which had cost you 25,000 in the year 2016. Note that there's no date there because all you need now is a year. And the 25,000 van was purchased in the year 2016, which would mean the year it was acquired. Was traded in for, and you got an allowance of 14,000. And you purchase a new van then costing 40,000. And then once again, they say the check for this transaction was incorrectly treated as purchase trading stock. So let's get the depreciation of delivery vans for the year first of all. So depreciation on delivery vans, you must get the cost of delivery vans because it's based off cost, right? If you go to the trial balance, you'll see that the cost of delivery vans was 155,000. You are getting rid of a delivery van which would cost you 25 grand, and you're replacing that with a new one that's going to cost you 40,000. So that gives you a new cost of vehicles of 170,000. If you think about it, okay, this here is the item you're disposing of, and this is the one you're acquiring. Therefore, there is no depreciation on this item, there is depreciation on that item. So what I have to be careful of here is, a lot of people in the exam divided this 170,000 by 5. You must multiply it by 95% because it's never going to be worth zero. So you're just depreciating 95% of it because you're always going to keep 5% of the cost as scrap. So that figure then is 161,500. So that's the item that the amount that we're going to depreciate. So 161,500 divided by 5, okay, gives us 32,300. And that there was your selling and distribution expense. Okay. The next thing we need to look at here then is, as always, did we make a profit or loss on the disposal? Okay, what item are we looking at? Well, we're looking at delivery van that costs us 25,000. And what we need to do is we need to calculate the accumulated depreciation on this item. The first thing you must know is you must multiply this by 90% again. Okay, and that gives you then the 23,750, and that's the figure that you're going to use to depreciate. Remember, it's always on a straight line basis over 5 years. And I had this for technically I had it in 2016, 2017, 2018, but I acquired it in 16, had it for 17, and disposed of it in 18. So I'm only going to depreciate it for 2 years. So that gives me a figure of 9,500. So that's your accumulated depreciation on the 25 grand delivery van. So what I got to do here is to say, well, if the cost of this delivery van was 25,000, and my depreciation that I've charged on this vehicle was 9,500, the difference between the two is the net worth of the vehicle, which works out to be 15,500. We're told in the question that you're getting an allowance of 14,000 for this vehicle. Therefore, we're making a loss of 1,500. Okay, so I'll just tidy that figure up. 1,500. Okay, that is loss on disposal. This here, therefore, is a selling and distribution expense also. So I'll come over here and to show you then that the delivery vans in the balance sheet, what it looks like. Well, the cost is 170,000. You can see here from this figure here, that's your new cost for your vehicles. Okay, your depreciation, you must go back to the trial balance and look at the delivery vans. It was 155,000 as cost, but your net book value in the debits column of the trial balance was 120,000. So the difference between the two is 35,000. So that was your accumulated depreciation to date. Okay, we add in this year's depreciation, which is 32,300, which we worked out there in working number 5. But we subtract, okay, this figure 9,500, which is of the item that we're disposing of. Okay, and that gives you a figure, okay, of 57,800. So these two figures is what you're going to need for your fixed assets when you're doing your delivery vans. Okay, once again, we must go back to purchases. Okay, we're going to subtract the amount that this transaction was worth. If the new vehicle is 40,000 and they're giving us a loan of 14,000, well, then the check that I must give to the garage is 26,000. That 26,000 was not purchases of stock, it was purchase of delivery van, which you've now corrected down below. Okay. Okay, moving on to the next working. It was discovered that goods had been sent to a customer on the 31st to 12th, 2018, so at the end of the year, on a sale or return basis. We have seen, okay, when we have been the ones receiving these goods and what we do with that, but in this case here, we are the ones now sending the goods. So this is to do with sales, debtors, and closing stock. Okay, so I need to open up sales here now. Okay, the sales figure from my trial balance is 1,590,000. I must subtract, okay, the 7,500 because I have not received sales of 7,500 just yet. It's on a sale or return basis. So I was too quick to put that into sales. So I must now subtract it. And it's the full amount because that is your recommended selling price. What you do then also is you open up debtors because I've obviously charged my debtors if I put it into sales. So your debtors figure from your trial balance is 98,200. You must also subtract the 7,500 here because I charged my debtor 7,500. Okay, that was too premature. Okay, because they have not agreed if they're going to take this items as a sale. And the last thing I need to do is go back and fix my closing stock. Now my closing stock is always based off my worth. I've taken goods out of my stock and treated as a sale. Okay, but I must add these back in. Yes, they're not in my warehouse, but they haven't been treated as a sale yet, so I do nothing with them as of now. So it's a 7,500 divided by 1.2, which gives us 6,250. So I add back in that 6,250. Okay. If you want, lads, sometimes it's nice for notes. You can put in here, this is your sale or return. This was to do with damaged stock. Okay, this 7,000 is to do with your fire. This 26,000 was to do with your van. Okay. The 5 or 7,000 it was, yep. Okay. Now, that's that taken care of. Okay. So the next working, one that you'd be quite familiar with, working 10, is to do with patents. Okay, your patents figure in the trial balance, you can see there, incorporates 5 months investment income. So this 43,500 is not the true figure for patents. So we must work out what it is by working out what 5 months investment income is. So to work out 5 months investment income, we go to investments. We can see investments is 360,000. We're going to multiply that by 3%, okay, and multiply it by 5 over 12. And that gives you 4,500. We add that 4,500 back onto 43,500. We get our true patents figure to be 48,000. We can now depreciate, or not depreciate, but write off these over 5 years, okay, and that gives us 9,600 for this year. And that there is your admin expense. So now 48,000 subtract the 9,600 gives us 38,400. We can now bring this figure into our trial balance under intangible assets. Okay, the next item that I will adjust will be my investment incomes. Okay, again, your investment is 360,000 by 3%. Now, we got our investments on the, I can find them, the 1st to 4th. So that means we have them for rest year, which is 9 months. And 360,000 by 3% by 9 over 12 gives us a figure of 8,100. Okay, that figure there is your gain. What we expect to receive from investments for this year. Now, up in patents, we've already received 4,500. So you subtract that 4,500, and that leaves you with 3,600 still outstanding due to you. Therefore, that's a current asset. All right. The next working, okay, leads us on to suspense. And again, something you'd be very familiar with your sole traders. As always, there's 2 parts to suspense. In this question here, we've got debenture interest. Okay, you'd be used to mortgage interest, but it's just this debenture interest is considered a long-term loan for a business, where the mortgage would be for a sole trader. Okay, and once again, it's to do with your bank. We said the incorrect figure was put into debenture interest. So we go over to the trial balance. We can see debenture interest paid for the first 3 months was 6,400. Okay, we know this figure is incorrect, so we must get to the bottom of it and discover what the real debenture interest was. So we go up and find the debentures here, okay, is 7%, including a 60 grand increase on the 1st to 4th. Now we don't want April onwards, we just want January, February, March. So the first 3 months, so it's 300,000 minus 60,000 then is the amount that we want to charge interest on, which is 240,000. The interest rate was 7%, and I want it for the first 3 months. Okay, so that means 240,000 by 7% by 3 over 12 gives us 4,200. So that 4,200 would be a credit entry in your bank as it's an expense. Okay, sorry, as it's money leaving your bank account. Okay, not an expense. So 4,200 and 6,400 means that the debit side is up, okay, by 2,200. Okay, we can move on to the B part now of suspense. The B part of suspense, once again, is discount. In this case, it's creditors. You're used to doing with debtors a lot of the time. Okay, discount received is a gain. Therefore, discount received should have gone into the credit side of your discount account, but it only went into the creditors account. Okay, if it's a credit entry here, it must be a debit entry in the creditors account because obviously you're reducing your liability, which is your creditors. So that means once again that the debit side was up by 460. If you remember, the debit side was up by 2,200 on the A part of suspense, which means we have a total debit up by 2,660. Now, as we can see here, working number is this, working 13. Okay, our suspense was incorporated in salaries and general expenses. Okay, the figure we get from a trial balance from salaries and general expenses was 243,100. Okay, if our debit side was up and salaries and general expenses by its very nature is expense, so it's a debit entry, and the debit side was up by 2,660, to correct it, okay, they would have subtracted it, so now we need to add it back on. And that gives us a figure of 245,760. Now there is another entry for salaries and general expenses, okay, and I'll return to it shortly. And that would be an admin expense. So the next working then, okay, is to do with a depreciation of buildings. All right. The actual working looks a long-winded, but it's very short and simple to do. Okay, it says here that the company revalued land and buildings for 975,000 at the beginning of this year. Okay, they just haven't put it into the account yet, is all. And they're telling me that of this 975,000, land is 150,000 of it, and they want us to depreciate buildings at 2%. Okay, therefore, it's 975,000 minus the 150,000 because they never asked us to depreciate land, just buildings. So your land value here is 825,000. Multiply that by 2%, okay, and you get 16,500. And that there is your admin expense for buildings. Okay, depreciation. Now in the balance sheet, the cost for your buildings will be 975,000. And the depreciation, there is no accumulated depreciation because you revalued it at the start of the year, so all that depreciation is gone. Okay? So you don't need to worry about all that accumulated depreciation on land and buildings. So your depreciation here is 16,500. All right. Now I'm going to just pause it there, lads, because I want to keep these videos short, and then I'm going to put up another video continuing on from this. Okay.